Hi everyone. Okay, cool. So we're gonna talk about central bank and interest rate cycles. Hi, for those who just joined. Okay, once again, hello everyone. Welcome to today's webinar brought to you by Vantage. We're gonna be talking about central bank and interest rate cycles. I'm gonna be a speaker for today. I'm gonna introduce myself a little bit in a little bit. Today's the 18th of November. It is 5 p.m. here, well, 5:04 here in Singapore. I don't know where you guys are tuning in from. Do let me know in the chat box where you guys are from. I want to know. Also, I also want you guys to know that you can be comfortable with me. Don't feel shy or anything. I want this webinar to be interactive. So talk to me in the chat box. You don't have to worry about delaying the webinar or delaying me or worrying that I cannot finish. I think I should be able to finish the whole slides way before the 1 hour, and then we can do a Q&A session. So don't be shy. Let's talk to each other. Oh, interesting. Today, the Vantage app isn't moving that much. I mean, the chat isn't moving that much compared to other days. Usually it's crazy on the Vantage app and I totally cannot see what's happening. Sorry, I've been talking a lot today, so I'll be having a lot of water breaks. Okay, let's start. Oh, yes, before we actually start, you guys know this part. This is very important. We need to go through the disclaimer. So I'm gonna stay here for a minute or two so you guys can read the disclaimer. But basically, the disclaimer is a reminder to tell you guys that whatever I share in this webinar is purely educational. It should not be construed as any kind of investment advice, any form of financial advice. It is not a signals group to buy or sell. I am merely sharing information and knowledge in terms of like the economy, in terms of trading, in terms of viewing the market. It's just a different perspective. Okay, it's for you guys to absorb this information and do whatever you want to help you become a better trader with the information that I'm sharing, okay? But please do not take this as any form of financial or investment advice, okay? It's nothing like that. Okay, so I'm going to stay here for a minute or two. Also, just a risk warning, right? Trading Forex and CFDs, especially if you are trading on margin, carries significant risk and it's not suitable for all investors. You may lose more than you intend to. It is very important that you guys do not get cocky and stay humble, because even for me, for someone who's been trading for close to 10 years, I still lose money sometimes. I still get way ahead of myself and I still like, even for me, it's dangerous. Okay, so please do not jump into the ocean before learning to swim. Please learn the skills that they are in trading before you actually jump into trading. I don't want anyone to be losing more than they intend to. Okay. Losing more than they have, even, because I know some people actually borrow funds to trade, which is like crazy to me. It's so risky, so dangerous. Please don't do that. Okay, guys? Okay, cool. I hope I don't have to do a toilet break because I'm drinking so much water. But yeah. Okay, I want to introduce myself. For those who don't already know me, my name is Cassandra, or you can call me Cass. It's a little more casual that way. I am an investment analyst at Everest Fortune Group. We are a research firm that is based in Singapore. What we do is a lot of forecasting, back testing, a lot of research on where the markets are going. If you are a doctor and your 9 to 5 job is basically to look at patients, my job as an investment analyst is basically to look at the charts from 9 to 5 and study it and understand it and come up with reports of what I see in the markets. Okay, so that's basically my job as an investment analyst. I thoroughly study the markets. Okay. The firm that I'm with, Everest Fortune Group, we have been recognized as the finalists for the best Forex and best equity research. This is important because it means that whatever we are forecasting, whatever we are sharing is quality information, and we're not just sharing things that we pluck off social media. Okay, it is things that we really deep dive into research, and that these are the things that I'm sharing with you guys in this webinar. Okay, on top of that, I am not just a researcher. I'm not just someone who just studies the market. I'm also a trader. I'm a prop trader, actually. For those who don't know what prop trading is, it means that I am funded by multiple companies to trade their funds. How did I get this funding? Well, obviously, if you study the markets enough, you will see a lot of patterns. So I basically got it by using technical analysis, and I passed all the tests that were required of me to get the funding. So the test that a lot of people find is hard is to do 10% profit within a month. For me, 10% profit isn't that hard. I do it very often. Actually, last month I ended with about 8.5% profit. Okay, that's just my trading account. So we're not even talking about my investment account. So when I segregate my investment and my trading account is where I'm trading in and out the market on a daily basis. Investment is where I buy and hold for long term. So for example, I buy cryptocurrency and hold it for a long term, or I buy stocks and I hold it for a long term. Okay, that's what I mean by investment. But when I say trading, to get the fundings, I mean trading and then getting a profit of 10% within a month. Okay, so that is, I guess I consistently do that on a monthly basis. It differs for me usually about 6 to 8%, or if not, sometimes 10%. Okay, so if you guys have any questions regarding trading or anything, even if it's not related to today's topic, as long as it's regarding trading, you can ask me in the chat box and I'll try my best to answer you to the best of my ability. Obviously, I won't have the answers to everything, but if I do, I will answer you to the best of my ability, because I don't have the answers to everything, because no trader, no investor will have the answer to the entire market. It's not even Warren Buffett. Okay, so if you ask me a question and I cannot answer you, I'll just let you know. Okay, our agenda for today is to understand how monetary policy shapes forex and bond yields. And then we're going to understand rate hikes versus cuts, winners and losers in forex, carry trade opportunities in different cycles, and why forward guidance matters as much as actual decision. So if you guys have been following me for a while, you will notice that a lot of my webinars, I focus a lot on the winners and the losers. Okay, why? Because you need to know who is winning and who is losing. And it doesn't matter. It can be forex, cryptocurrency, commodities, whatever it is, whatever you are trading or whatever you are investing in. You need to know who the winners are, because then you need to move so that you have the information, and then you can move your funds to the winners and take out your funds from the losers. Okay, for example. That's why in a lot of my webinars, I will do a lot of comparison of who the winners are and who the losers are. That way you know where to put your money and where to take your money out of, or not even taking your money out of, but where to short the market. Okay, so how monetary policy shapes forex and bond yields. Okay, anyone has any questions so far? No? How do I get the slides for today? You are going to have to email Vantage on that. Just a reminder, right? I am actually an investment analyst from Evers Fortune Group. So we are a third-party research firm that Vantage has invited to do these webinars for you guys. So I don't actually have access to the back end of Vantage. So anything regarding this webinar, whether you want the recording or you want the slides, just email Vantage. Yeah, just email Vantage and they will send you the link or the copy. Okay? Okay, all right, everyone. Before we jump into the charts or correlations or whatever it is, we need to understand one thing. Central banks are the heartbeat of global finance. Okay, that's one thing you need to understand. Every pip you trade, every yield curve you analyze, every rally or crash you see, all of it in some way traces back to central bank decisions. So what exactly do they do? Their job is to control the cost of money, which they do through interest rates and monetary policy tools like open market operations, quantitative easing, or reserve requirements. So when the economy overheats, right, inflation runs too high, jobs are abundant, and spending surges. Central bank steps in to raise interest rates. That's like applying brakes to the economy. It makes borrowing more expensive, which slows demand and cools inflation. When economy slows or crashes, like during COVID, they cut rates or print money to encourage spending, lending, and investing. That's why pressing it's like they're pressing the accelerator, okay, on the car, on the economy. Okay, so here's the interesting thing. Markets rarely react to what the central bank does today. They react to what they think the bank will do next. That's why traders hang on to every word from the Fed chair or ECF president. It's not about today's rate, it's about tomorrow's expectation. So as a trader, we don't just follow policy, we trade anticipation. Okay, so why is it important that the economy is always controlled? Why is it we cannot continuously have a good economy? Why is it we cannot continuously have a bad economy? If we continuously have good economy, right? People are like constantly spending and there's no breaks, there's no control, it actually affects inflation. Okay. Right, it actually affects inflation. So we do need to have a control. Okay, so I've put a little chart here of how the central bank kind of works when it comes to official interest rates. There's going to be the money market, the interest rate, the actual interest rate. There's going to be the expectation, and that's where the markets okay, so you know how usually people go on the news and they wait at like 9 p.m. or 9:30 p.m. for Powell to talk? Okay, that's the expectation. So when the expectation is met, usually the markets don't really move that much. But if the expectations don't meet, where it's higher or lower, then you see the markets dipping or like rallying based on what the results are coming in. So how do you understand that part? We will look into that later on when we go into the next few slides. Okay? Okay, so now let's talk about like the link between interest rate, forex, and the bond yields. Let's try to connect the dots. How exactly does monetary policy affect forex and the bond markets? Right? I know. Okay, so before I actually took you guys for this series, you know, like back then I used to share technical analysis with you guys because I do specialize in technical analysis, right? That was until at one point Vantage was like, okay, hey, Cassandra, can you stop sharing about technical analysis? Can you share about the economy, the interest rate? Can you share about central banks, microeconomy, macroeconomy, geopolitical tensions and whatnot? Basically anything to do with like fundamental analysis. So then this is when I started realizing when I'm doing all this research for you guys, this is when I realized that actually everything is interlinked. I used to tell myself like, okay, I don't really need to understand how the news work. I don't really need to understand how the economy works as long as I'm really good at technical analysis. And for a long time, I have been making profits from just technical analysis, but I noticed that my trades and a lot of my trades have been getting way, way better when I have been combining all of this together. So I do try my best to still follow interest rate as much as I can. So like I said, let's connect the dots. How does monetary policy even affect Forex, which is important to us? I'm assuming majority of us here are Forex traders, right? If you are not a Forex trader, if you're something else, let me know in the chat box. But how does it affect Forex and how does it affect the bond market? So when a central bank raises rates, investors chase higher yields. Okay, money flows into countries' bonds and currency to earn better returns. So this causes the currency to strengthen. Okay, classic example, when the Fed hiked aggressively in 2022, the US dollar surged against almost every major currency. Conversely, when the central bank cuts rates, investors look elsewhere for returns. Capital flows out, yields drop, and the currency weakens. That's why during periods of quantitative easing or QE, like the ECB in the 2010s or Japan for decades, their currencies remain under pressure. So now let's talk about bond yields. Yields are basically the market's expectations of future rates. When the traders think central banks will hike, they sell bonds, pushing prices down and yields up. When they expect cuts, they buy bonds, driving prices up and yields down. Okay, so Forex traders and bond traders are essentially playing the same game, just in different instruments. Both are betting on where interest rates are headed next. That's why you'll often see US dollar and treasury yields move together. They're a reflection of the same expectation. Monetary tightening or easing is always important. Okay, so I've got a question. Someone's asking, does that mean I always have to follow the news? That's a very good question. I would say if you can, you should follow it closely, but only if you can. I won't say that if you don't follow the news, you cannot be a profitable trader. You can still be a profitable trader because I personally was not following the news for many, many years and I was profitable. I'm still profitable in trading just using technical analysis. But like I said, I noticed that when I do follow the news and I combine the data from the news and I combine it to my technical analysis, I find that my trading becomes more accurate and my win rate has increased a little bit. Okay, so just the important thing you need to remember, which I actually placed here. Okay, higher rates equal to stronger currency. Okay, then you will have a capital inflow. Lower rates equals to weaker currency, then you will have a capital outflows. Okay, that's a very important thing you need to remember when it comes to Forex. So it doesn't matter what currency you're following. It can be Japan, the US, Germany, euro, whatever it is, as long as there's higher rates, it means that it's going to be a stronger currency and there will be capital inflows. And therefore, you will see currency going up. You will see, let's say you are trading AUD, USD. If Australia raises higher rates, then you will see the Australian dollar strengthening, for example. And that's how you combine the news or the information, the fundamental analysis with the technical analysis to make your entire analysis more accurate. Because let's say you are doing technical analysis on AUD USD and it's pointing down, for example, it's pointing for a sell, it's showing you a sell. But at the same time, Australia is increasing rates, right? Australia is increasing rates, which means that there will be a stronger currency. Okay, that is where there is no alignment, and that is where you shouldn't get into for a trade. Okay, that's one example. Okay, so I used to only use technical analysis, and now I combine both. And again, I noticed that my trades have increased in win rates since I started doing it. But again, only if you can follow the news. It depends on your lifestyle, really. I personally, I try my best to follow the news as much as I can, but like a lot of times the news comes out at like 9 p.m. and I'm still having like my family dinner or I'm still out with my family, so I cannot really follow it closely. Or sometimes it comes out at like 9:30 p.m. or like 8:30 p.m. Singapore time. I'm talking about Singapore time, right? And like that actually is a deterrence for me for following the news. But if you can, you should. Okay, guys, just give me a minute. I did not realize that my charger was not plugged in. My computer might actually turn off in a while. Just give me like 1 minute. I'll come back to you guys shortly. Okay, I am back. Can you guys let me know if you can hear me? You can see the screen, everything is good. I muted myself for a while. I'm wondering if we're back on. I'll check on the Vantage app as well. Hello, testing. Okay, everything's working fine. I'm gonna continue. Sorry, I'm so glad I noticed that my battery was running out before it actually ran out. Sorry about that, guys. Okay, I'm gonna continue. So how do we apply this as traders? How do we apply this information as trader? Thank you, Karsten. Okay, first, always listen for the tone. Okay, central bankers speak their own language. Okay, sometimes I've listened to Powell talk, and sometimes I'm just like, what are you saying? Like, are you saying it's good or bad? I don't know. Okay, so it's important. This is also why at one point I gave up following the news. I mean, recently I've been trying my best to follow it as much as possible, but at one point I stopped following the news because I just couldn't decipher what Powell was saying. I couldn't decipher what they were saying. So it's important to understand what they're saying. So central bank speakers, they usually have two tones. One is hawkish. It means that they're worried about inflation and leaning towards rate hikes. And one is dovish, okay, means that they're worried about growth and leaning towards cuts. Okay, so how do you understand this? How they talk? You really need to listen to the tone of how they're saying it. You need to go and watch like when they're making the announcement, and there's going to be like doubts. Okay, for example, if they think that they are worried about inflation, for example, they will say um like, okay, the economy is performing a little too well. Okay, that's just an example of what they would say. Okay, so then it's hawkish, and you know that okay, maybe a rate cut might come soon. Okay. So it's important to kind of understand the tone. I don't know why they talk like that. Why can't they just say it as it is? Okay, I know because if they say it too directly, then the market is gonna crash. Okay, the market is just gonna move too fast. Okay, so secondly, you need to track data dependency. They make decisions based on inflation. So that's CPI data, jobs, which is unemployment rates and NFP, and growth, which is GDP. When inflation comes in hot, expect hawkish talks, and jobs weaken, you can expect dovish tones. So the third is to pay attention to bond markets. Bond yields are the most honest storytellers. Okay, if yields are rising, the market expects hikes, even if the central bank hasn't confirmed it yet. Lastly, align your trades with the policy trend, not against it. Don't try to fight a tightening cycle by buying a weakening currency or shorting a strengthening one. You might be early, but the market doesn't reward early. It rewards right timing. Okay. Um, it's a very good example to this is actually, I don't know if you guys have ever watched this movie called The Big Short. The Big Short. So they predicted that the 2008 crash was gonna happen, but they got in a little bit too early. One of the investors got in a little bit too early. So for a long period of time, he was like losing a lot of money. We're talking about like hundreds of millions of dollars before finally making all of that money back and way more. So again, it's okay to be early, but it's provided if you are here to hold for long term. If you are a day trader, if you are just someone who's holding for a week or maybe a month, being early is not as rewarding as being on the right time. Okay, so that is important. Okay, so when the Fed say higher for longer, you need to listen because interest rates don't just change borrowing costs, they rewrite the entire risk landscape for every trader in every market. Okay, now let's try to understand our next topic, which is rate hikes versus cuts and the winners and the losers. Okay, this is my favorite topic. I mean, not exactly every time I touch on the winners and the losers, I really like it because then I know where to go long and where to go short. Okay, guys, let's break this down slowly because this is one of the most important relationships in Forex. When a central bank raises interest rates, what they're really doing is making money more expensive. Okay, borrowing becomes harder, saving becomes more attractive, and yields across the entire economy tend to rise. Now, for a currency perspective, rate hikes are like a magnet. They attract foreign capital because global investors suddenly think, hey, the country now pays more interest. I want a piece of that. Okay, so what happens? Forex demands rises and the currency strengthens. This is why during the Fed's aggressive hike cycle in 2022 and 2023, the US dollar skyrocketed, not because America was doing great, but because the returns were great. Investors dumped lower yielding currencies like Japanese yen or the euro and chased the USD for yields, right? Because if they increase interest rate, if I put my money in the US dollar, right, then I will get more in return compared to other lower yielding currencies. So rate hikes also send a psychological message: we're serious about fighting inflation. This boosts investors' confidence, strengthens the currency, and creates a risk-off flow into stable, high-yielding assets. So in short, rate hikes means that there is a strong currency, there is a capital inflow, and there is a strong bond yield fight to safety. Okay, now let's talk about the flip side, which is the rate cuts. When a central bank cuts rates, it makes money cheaper. Borrowing becomes easy, saving becomes unattractive, and yields across the curve fall. So to investor, that signals two things. Number one, lower returns on bonds and deposits. And number two, the central bank is worried about growth. So what do investors do? They pull their money out and send it to the market, offering better returns or more stability. Okay, this instantly weakens the currency because there's less demand for it. A great example is Japan, where decades of low to zero interest rates kept the yen weak. Investors simply didn't want to hold a currency that earned nothing. Another strong example is ECB during the Eurozone crisis. Rate cuts pressured the euro because euro needed to stimulate growth. Cut tends to happen during fear. So it happens during economic slowdown, recession risk, poor employment data, and banking and financial stress. So that's why Forex traders say currencies follow yields. Lower yields equals weaker currency. So remember, rate cuts means that currency weakens, capital outflow, and risk on condition temporarily, and usually inflationary pressure. Now let's put it all together into something you can actually trade. So when trade rates are rising, the winners are usually, okay, US dollar, which is the Federal Reserve hikes, Canadian dollars, which is the Bank of Canada tightening, New Zealand dollars, the Reserve Bank of New Zealand is known to be hawkish, okay, and the Australian dollar at certain parts of the cycle. So the British pound sometimes is also considered the winner when inflation runs hot. Okay, so these countries strengthen because investors want exposure to higher yields. On the other hand, the losers during hiking cycles are usually the Japanese yen because they are perpetually low yielders, the Swiss franc, which is usually the safe haven currency, but It usually comes with low interest. The euro, historically is slow to tighten. They do tighten, but it's just that their reaction is a little bit slower compared to the ones that I was talking about. And the Chinese yen, okay, during growth slowdown especially. Why? Because when the world is hiking, these currencies fall behind. Traders rotate out of them into currencies that are better yield prospect. So from a trading perspective, one of the best setups is when rate differential widen. For example, Fed is hiking, okay, but BOJ is stays ultra loose. So the USD JPY flies upwards. Or the Reserve Bank of New Zealand tightens when ECB remains dovish. So then you can look at the New Zealand EUR rising. Rate trends can last for months, even years. That's why macro traders say don't fight the yield curve. Okay, follow the yield curve. It will help you understand the currency pair that you are trading better. So to summarize, rate hikes creates winners because it creates strong currency, and rate cuts create losers because it create weaker currency. So the biggest opportunities come from the difference between two countries' policies, not just one. And this is exactly where Forex profits come from. Capital flow chasing yield across borders. Okay, so now let's move on to our next topic, which is to carry trade opportunities in different cycles. Like, how should you react and what should you do when things are constantly changing? What exactly is a carry trade, first of all? Right, so let's talk about the carry trade. One of the oldest and most profitable strategies in Forex when done correctly. Okay, all strategies in Forex when done correctly is profitable, just so you guys know. Okay, so how do you make it? How do you understand the carry trade? So the concept is simple. You borrow or fund your position in a currency with a very low interest rate, and you buy a currency with high interest rate. You're earning the interest rate differential every single day you hold the position. So for example, if Japan's interest rate is negative 0.1%, for example, okay? And New Zealand rate is 4.25%. A trader holding NZD JPY longs earns the 4% difference minus the broker's adjustment, obviously. This is why currencies like JPY, CHF, and sometimes Euro are called the funding currencies. They cost almost nothing to borrow. And the currencies like NZD, like New Zealand dollars, AUD, MXN, TRY, and typically ZAR are known as the carry currencies because they pay high yields. But here's the key point. Carry trades work beautifully when markets are calm, predictable, and risk on. Because in stable conditions, traders are willing to hold positions for yield rather than chasing short-term price moves. The moment volatility increases, carry traders unwind fast, which can cause violent currency moves. So carry traders, would be great for carry traders. It will be great in calm markets, but it will be dangerous in chaos. I personally don't carry trade, by the way. But yeah, it's just something that is good to know. Okay, so carry trades are extremely cycle dependent. Okay, when do carry trades thrive? They thrive when the global environment is predictable. Stocks are rising, inflation is under control, central bank give clear forward guidance, interest rate differentials are stable, and volatility is low. Okay. To check volatility, you can use the VIX, and it has to be below 15 or 20, and that will be showing a low volatility. Okay, so this is when investors say, Why keep cash when I can earn yield in currencies? And they pile into like NZD JPY, AUD JPY, MXN JPY, or even USD TRY at times. You'll see slow, steady upwards trend like NZD JPY grinding up for months. When do carry trades collapse? The moment fear enters the market, boom. Okay, carry trades die instantly because traders unwind leveraged positions to escape risk. That unwinding causes JPY to strengthen rapidly, funding repatriation, to strengthen, high yield currencies to drop sharply, and big gaps and long wicks on charts. So a very good example is the 2008 crisis. AUD JPY fell about, if I didn't remember wrongly, 6,000 plus pips. Okay. And in COVID 2020, the JPY skyrocketed as carry trades unwound globally. Okay, so Swiss franc also shocked in 2015, where CHF exploded when SNB removed its peg. So you must always ask yourself, what cycle are we in? Are we in a risk on or risk off cycle? Carry trades only love stability. They absolutely hate stress. Are we in a risk on or risk off cycle right now? I actually think we are on a risk off cycle at this current point of time. I don't know if you guys are noticing that gold, US dollars are all dropping in prices. So a very good indication for me, at least, okay, that I like to use is to track gold. When gold is rising up, you know that there is some kind of fear in the market. Okay, when gold is like retracing or pulling back, like it is right now at this current point of time, you know that people are taking out their money from gold and probably going to a little bit more risky assets. I'm expecting like cryptocurrency to also go up, because if it is a risk off, then cryptocurrency should be going up. But at the same time, cryptocurrency is also still not going up. Should give me a moment. I was checking Ethereum earlier on, and it is pulling back. I'm not sure about now. In the last few days, it was pulling back, but like cryptocurrency and gold is supposed to go the opposite direction, because one is a safe haven metal and one is a risky asset. I mean, depending on how people see it. I know nowadays some people think that cryptocurrency is safe haven, but like I think it's still risky. Okay, so how to identify carry opportunities and to avoid traps? Let me break down a framework you can use. Okay, number one, you want to check the yield differential trend. First, don't guess, look at the actual interest rate difference. Okay, so you can look at NZD-JPY, AUD-JPY, MXN-JPY, USD-ZAR. If the differential is widening, the carry gets more attractive. Number two is to confirm the policy direction. You want one central bank hiking while the other stays flat or cuts. So example, Fed hikes, but BOJ stays ultra loose, and JPY USD bullish will end up bullish and carry trend. Sorry, I got a question here. Cass, do you mean gold increases during risk on, or gold is safe haven? Thanks. Thought gold, USD, JPY were safe havens. Yes. Okay, so when there is a risk on in the market, gold usually increases in price. Yeah, it usually increases in price. Gold is a safe haven currency. And thought gold, USD, JPY, CHF were safe havens. Yes, those are safe havens. So when there is fear in the market, risk on, meaning that there is, oh, sorry. I think I got the terms wrong. Risk off is when you go to gold. Sorry, thank you, Nina, for catching that. Thank you, Nina. Okay, yes. I mean risk off. When it is risk on, then you get away from gold. because you are taking risks by going into cryptocurrency, right? You are taking risks by going into non-safe haven assets. When it is risk off, when you do not want to take any risk, that's when you go into gold and you go into the safe haven assets like gold, USD, JPY, and Swiss franc. Thank you for catching that. I got the terms wrong. For those who are new, please let me repeat myself. When it is risk off, inflow of capital will go into gold. Gold, USD, JPY, CHF, and where it is risk on, you will see money coming out from those safe haven. Though I agree it is risk off right now, right? But gold is still decreasing. I was just looking at the gold charts like right before I started this webinar. So about like an hour ago, I was looking at the gold charts. I don't think that gold is decreasing in price where it is a trend reversal or anything. I think it is just a pullback, right? I was doing my technical analysis as well, and I see that it is doing a pullback. So if you guys, okay, you guys have never seen me trade. You guys have never seen me do my analysis. But when I do my analysis, I use this thing called Elliott wave to do my analysis. So Elliott wave is basically a technical analysis method to do analysis on the charts where Mr. Elliott, I cannot remember what's his first name, something Elliott. So Mr. Elliott noticed that price is constantly moving in a 5-wave pattern where it's moving 1, 2, 3, 4, 5, followed by a pullback of A, B, C. So 1, 2, 3, 4, 5, followed by a pullback of A, B, C. Once the pullback is done, it will continue with 1, 2, 3, 4, 5 again. So it's not so much when I did my analysis on gold just now and yesterday, I noticed that 1, 2, 3, 4, 5 has just ended. Okay, this is provided my analysis is correct. Okay, if my analysis is correct, I've noticed that gold has ended 1, 2, 3, 4, 5, and right now it is pulling back ABC. Okay, so it is just a pullback, and later once the pullback is done, it's going to continue again. So it could just be, I think it is risk off as well, but it just could be a short break from the risk off sentiment. And later, once the pullback is done, we will start seeing risk on again. Sorry, risk off again. We will start seeing money coming back into gold again. Okay, but right now it is just, I think it's just doing a pullback at this current point of time. But yes, thank you, Nina, for catching that. And sorry for everyone if I'm confusing you. Okay, so where was I? So look at volatility levels. That's number 3. Carry only works in low volatility environments. If the volatility indicator is above 20 or 25, volatility indicator, you can use VIX. Forget it. Just carry unwind are lurking. When you are using Elliott wave, which time frame are you using? I was using it on daily and the 4 hours. So if you guys know and understand Elliott wave, you can use Elliott wave on all time frames because, okay, this is me charting on the daily, for example. This is the daily chart, for example. 1, 2, 3, 4, 5. Okay, 1, 2, 3, 4, 5. If you go into the smaller time frame, which is the H4, within the daily 1, 2, 3, 4, 5, you will see 1, 2, 3, 4, 5, followed by A, B, C, followed by 1, 2, 3, 4, 5. There are sub waves within sub waves within sub waves within sub waves. That's why every time frame will have one wave, and then you go down into the smaller time frame. It is just the sub wave of a bigger wave. Okay, I don't know if you guys are understanding it, but Elliott wave is not something you can understand just by one sentence. It is something, Elliott wave took me months to understand. For me to even understand the concept, it took me months. It took me months and months of practice. I would say now I'm quite an expert in Elliott wave, but it took me many, many months to understand. Yes, I've been learning Elliott wave. I love Elliott wave. It has made me so much money. I can tell you that much. Okay, so let's move on to number 4. Stick with the major crosses. Exotic carry pairs like TRYJPY or ZARJPY can look juicy, but they come with massive volatility and unpredictable political risk. Number 5, avoid carry trades before high impact news. Central bank speeches, CPI releases, NFP or geopolitical headlines can kill a carry setup instantly. Number 6, combine fundamentals with trend following. Carry trades tend to trend cleanly when they are working. You often see months-long bull trend supported by rising yield. So don't overcomplicate it. Follow the direction of both policy and price. And number 7, lastly, your stop loss must be wider. Your position must be smaller and your carry unwinds are violent and unforgiving. Okay, so yeah, that's all about carry trades. Let's move into the last part of our webinar. We have about 10 more minutes left. It should be enough to cover everything. If you guys have questions, don't worry, I'll answer them as much as I can. Don't worry about delaying the webinar. I will stay a bit later just to, if you guys have questions, I will answer your questions. It doesn't have to be related to today's topic. If you want to ask me anything, even if it's about Elliott wave, you can just ask me. I'll try my best to answer it. Okay, so why forward guidance matters as much as actual decisions? Okay, now let's talk about something that most beginners overlook, which is forward guidance. This is where the real game is played, not in the rate cuts itself, but in what central banks say they will do next. Okay, forward guidance is basically the central bank's way of giving the market a heads up about future policy. They don't want markets to panic, so they hint at what's coming. Okay, so there's always like, if you guys go and watch one of those like data releases, you will always see like hinting. There's a lot of like very vague talk. There's a lot of like, it's your ability to read in between the lines, honestly. Okay, so here's the twist. Those hints often move the market more than the actual rate decision. So for example, the Fed can raise rates today, but if Powell say this may be the final hike before we pause, the USD can temporarily or actually drop because traders hear a dovish tone, even though it is for the future. So the Fed might keep rates unchanged, but if the statement says we remain ready to tighten further if necessary. Okay, they give this like very vague talking, very vague statements. Okay, the USD can spike because that sounds hawkish. This is why traders say don't trade the decision, trade the expectations. Central banks know this. They craft every sentence, every comma, every pause to shape sentiments. They use forward guidance to influence markets without actually moving rates. And because Forex is essentially a market built on expectations, forward guidance become the true driving force behind currency strength or weakness. So yes, the press conference matters more than the rate announcements. The tone matters more than the numbers, and the future path matters more than the present move. Okay, so how forward guidance shapes Forex trends? Forward guidance is a bridge between current policies and forward price action. Traders don't just care about whether the rates are 4%, 5%, 6% today. Actually, most people don't even understand the number. So most people don't even care about the number. They care about where they're going. If a central bank says something like, we expect inflation to fall gradually, cuts may be appropriate next year, that's a dovish tone. Okay, traders start pricing in weaker currency, bond yields fall, and capital starts rotating up. But if they say something like inflation remains uncomfortably high, okay, once you hear the word uncomfortably high, additional tightening may be needed. Okay, that's definitely hawkish, and yield rise, currency strengthens, and risk of follow appear. The amazing part is all this happens instantly, even if rates haven't moved yet, because traders are forward looking. They don't wait for the slow official move. They front run the expected move. That's why you can see they say, oh, news is coming out at 9 p.m. By 9:10, you can see crazy moves happening. You will see markets like kind of like hovering sideways for a while, until a announcement comes out and the tone seems dovish or hawkish. Immediately you see the markets going boom. It just spikes one way and then goes the other way or whatever it is. Okay. Okay, so this explains phenomena like the USD rising before a rate hike, the JPY strengthening before Bank of Japan hints a policy normalization, GBP falling simply because the Bank of England sounds worried. You just have to sound worried, and the bond market especially reacts strongly when forward guidance suggests fewer hike ahead, long-term yields fall and the currency follow. This is why understanding forward guidance give you a massive edge. You're trading what's about to happen, not really what is happening in the market. Okay, so let's look at the last part of this webinar. So how do we actually trade forward guidance in the real world? Listen to the tone, not the headline. Again, you need to understand what is hawkish and what is dovish. They will say things you really need to go and watch. You need to listen. And then after a while, you notice Powell saying things like uncomfortably something like, oh, we don't feel good about this or whatever it is. Okay. So you need to understand the tone. You need to compare guidance with market expectations. Okay. If the market expect 4 rate cuts this year, the central bank hints at only 1 or 2. That means the currency will expand, strengthen. You need to watch bond yields and the futures, and you need to let price confirm its interpretation. Don't jump into trade during the speech, which most people do. Retest the broken structure. You need to combine it with technical analysis so that everything is better. Rejection from key levels and volume confirmation. And lastly, focus on the medium-term trend. Forward guidance isn't about scalping. It's please don't scalp. Okay, I just need to remind you, please don't scalp if you guys are following the news. Okay, you will get burned so badly. Okay, because sometimes your stop loss might not even get triggered because of how fast the news is moving. Okay, so it shapes multi-week and multi-month forex flows, but it's where swing traders and position traders shine. Okay, if you are a scalper, please don't do it. Okay, so that's all I have for you guys today. That's the end of my slides. If you guys have any questions, ask in the chat box, I'll answer them. If not, do follow Vantage on Facebook, Instagram, X, LinkedIn, and Telegram. These are their handles. I'm going to stay here so that you guys can take a picture or go and search whatever it is. Okay, I've got a very good question here. Why does the market sometimes drop, even when a central bank hikes rates like everyone expected? So why does it still drop even though the expectation is met? Because, give me a moment, I'll answer. Okay, I see a lot of questions coming. Okay, I'll answer one question at a time. Because markets price in expectations, not the event. If the rate hike is already expected, right, the actual hike becomes irrelevant because it's already done. What moves the market is whether the bank sounds more hawkish or dovish than expected. So if they hike, but it sounds cautious, then the currency can actually weaken still. Okay, so again, that's why I don't like to news trade. Even for me, I've been trading for so long. I don't like to news trade because for me, sometimes I feel like I might misinterpret it. But I mean, obviously, if you follow it long enough, you will notice patterns and you will notice how to interpret things better. Okay, another question is, hey, hi, so do I know if a currency is going to strengthen before the rate hike even happens? How do I know? Okay, look at the bond yields and futures. I think that's your best bet. Looking at the bond yields and the future is your bet. If yield rise weeks before a meeting, that's the market pricing in a hike early. In forex, if price leads policy, that means that the traders front run the announcement and the move already happened. Okay, so I've got another question here because I want to validate. Does it mean that if your 1-year bond rise, 10-year rise, you are will go down. Yes. To answer your question, yes, it will go down, but of course, it always looks at how reactive the market is. It can go down, but it could just be a pullback. It could be a temporary thing. It may not be a full like trend reversal. Okay, why does JPY always weaken in hiking cycles, even if Japan economy is doing well? Because okay, so Japan will historically keep the rates very low. So even if the economy is improving, the yield differential is still negative, right? So that's why the hiking cycle will still weaken for Japan. Okay, you need to take different currencies into expectation. So for Japan, it's always going to be low. Not always, but they always keep it low. That's why specifically for Japan, even if the economy is doing well, it's still weak. Their hiking cycle is still weak. Okay, so investors still prefer, I would say investors still prefer US dollar in general. Okay, US dollar, AUD, NZD, GBP, anything with higher rates. Okay, so if you guys don't have any more questions, I think that's all the questions. If you guys have any more questions, shoot me now. If not, I'm going to end the webinar. Okay. Oh, I've got one more question here. Now that the US government has reopened, what are your views on the market in general, given some data was not published last month? Okay. That's a very good question. Okay, based on my views, now that I would say the US, we're basically entering a period of information catch-up. Okay, because some key data wasn't published last month. Okay, I would say the market is kind of trading a bit blind and relying on more on sentiment and more on like the comments on Feds and high frequency indicators rather than the usual economic releases. So you're right, they are not releasing some of the views. So I think that's why for me, especially for my style of trading, I rely heavily on technical analysis, because in this way, it doesn't, this backlog of data wouldn't affect me so much. So with the reopening, the first thing the market will focus on, I think, will be the inflation prints. Okay, when they release, will be inflation prints, job data, consuming spending, and GDP revisions. Okay, so I hope that answers your questions. I'll see you guys next week. Okay, take care, guys. Thanks, guys, for tuning in. Take care, guys. Bye. See you guys next Tuesday, same time. I can't remember what I scheduled for you guys, but it's gonna be another economic heavy webinar. Okay, bye guys. Take care.